Well, for more on how all the debt talks and the gridlock that's going on right now is affecting the markets and what the markets could be, how they could be affected once we pass this August 2nd deadline, let me bring in the Director of Investment Strategy at Glenmede, Jason Pride. Also with us, of course, is Dominic and John Erlichman. And Jason, earlier I was talking with David Rosenberg, who seemed to sort of put aside the issue of the downgrade, said that wasn't as important as the fact that we need to pass this debt ceiling. For you, what is more important right now? Is it getting the debt package and lifting the debt ceiling, or is it the downgrade?
Look, I think all of this, when you start digging into what's going to happen here, if there is a downgrade or a default, it's likely going to be more of a temporary event than anything. But the interesting thing about this is that it's going to force the hands of legislators in one form or another, whether we get it ahead of August 2nd or whether we get it after August 2nd. These statements from the rating agencies, whether it ends up being a downgrade or not, it's perhaps more important that we're finally getting the deals put in place. So I perhaps agree with David Rosenberg on this note. There are some uncertainties surrounding what's going to happen if there is a default or a downgrade and how that ripples through the financial markets. But the bigger picture here, if you're looking at 3 or 5 years, we've made some pretty significant strides in the past 6 months in terms of negotiations from a point in which the debt commissions, the debt and deficit commissions proposals were almost laughed off at the start. And now we're looking at essentially $2.5 to $3 trillion deficit reduction proposals that there's some differences, but they aren't all that far apart.
Jason, I mean, we talk about all of this in such theoretical terms, big numbers that we can't grasp here. But what it comes down to is your clients and your investors that are with you right now. We heard Ed Yardeni talking about stock vigilantes, people selling the markets here because they don't like what's happening with Washington right now. Is there a longer-term impact that this will have on stock investing? Is confidence hurt by what's happening in Washington right now?
I think confidence has definitely been hurt by the inability to pass this legislation sooner. And we've kind of done this, pushing it out to the last moment a handful of times. And, we're not alone in this. Europe has done the same thing with many of their debt problems. These are hard decisions to make and probably are not decisions that you can make lightly. So it's likely not surprising that we're going through this. The bigger picture here, though, is we're going to be going through a fiscal belt tightening one way or another, whether the markets force us to or whether we do it by our own action through policy and legislation. The big picture of that is, there's going to be less government spending, less government stimulus. Economic growth is likely going to be a little bit lower than normal, probably not going to be dramatically negative for an extended period or even any period at all in there.
All right.
But it's going to be slower than normal, which provides a lower return environment for investors.
Jason, this is John Erlichman. Give us some numbers to chew on. In a worst-case scenario, how much of a sell-off are we going to see in stocks, do you think? Which sectors get hit the hardest? And when does the market bounce off those lows?
This is something where you're basically picking numbers out of the air because you look at this situation of a debt downgrade, which I think is the most likely case, and there aren't that many alternatives to look at or scenarios to look at where debt has been downgraded. There's one in Japan where it went from AAA to AA, and the market reaction, the fixed income reaction, was actually relatively muted.
You've got to tell your clients something. So what are you telling them right now?
We're telling them to watch out for a downside here, watch out for the disruptions from it. But the way we're dealing with it now is that we've been protecting investors with investments other than Treasuries. Essentially, we look at the investment environment as a situation where your most protective asset classes actually are the most expensive at this point in time and end up being, specifically related to Treasuries, the ones that are kind of the most pointed focus with this debt and deficit problem at this point in time. So there are other ways to kind of manage your portfolio and diversify and manage your risks to bring those risks down and not be taking astronomical equity risks.
I think what we want is specifics, though, Jason.
You can use, we've recommended multiple different strategies, whether it's high-quality equities to bring the market allocation of your equity side of the equation down, whether it's focusing in on the middle of the risk spectrum. If you think of equities being the high end, cash and fixed income being the low end, there's a lot of investments in the middle. High yield bonds are one opportunity. Alternative investments are another opportunity. High quality stocks are an opportunity, and secured options portfolios where you're protecting by selling calls against an equity portfolio.
Jason, thank you. Appreciate it. Jason Pride of Glenmede over there in Philadelphia.